Hello viewers and investors, welcome to another episode of Outlook Manage Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Mutual Fund. Today's topic of discussion is why ETFs are suitable for all kinds of investors. I am Kundan Kishore, Deputy Editor, Outlook Money, your host for this session. And with me today are Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential Mutual Fund, and Mr. Vishal Dhawan, Founder, Plan Ahead Wealth Advisors. To give a short introduction of our speakers today, Mr. Haria has been with ICICI Prudential Mutual Fund for more than 15 years now. He is someone who drives new and existing product at the AMC. Mr. Haria is also a mentor at Atal Incubation Center at Narseh Monjee Institute of Management Studies, Mumbai. Mr. Vishal Dhawan is certified financial planner registered with Financial Planning Standard Board of India, and he is a licensed life planner, one of the few Indians to be licensed by Money Percent USA. Before establishing Plan Ahead, Vishal worked with Vanvo Preferred Banking Unit at ABN AMRO, where he designed and developed value proposition for high net worth clients. So welcome Mr. Haria and Mr. Dhawan. It's a pleasure to have you for the show today.
So much.
Yeah. So let me begin with the question straight away. So I would like to go with Vishal. Vishal, could you please tell our viewers how are ETFs similar to stocks and index funds? And do we require Demat account for investing in ETFs?
So this one of the things that a lot of investors like to do is to be able to buy at a particular price because they know that stock prices, for example, move up and down. And ETFs give them exactly that feel because they're listed on the stock exchange and they can be bought and sold just like a stock.
Chintan, I would like to understand from you, how are units of ETFs created and redeemed? Can you give a short explanation on the mechanism or the process of forming the ETFs?
Sure, Kundanji. Thank you. And I think we've been doing a great job of explaining to investors everything about ETFs through the last couple of episodes that we've done. And today also the topic is quite good. So thank you for that. As far as how the ETF itself functions, it's a very simple way in which Mr. Vishal mentioned. An investor goes and buys on the exchange or sells it on the exchange. Those units which are being bought and sold on the exchange, on the other side of suppose you are buying, someone else is selling. If there is no natural seller on the other side, there is a market maker who will be basically providing the liquidity and selling to you. If you are selling and there is no buyer on the other side, the market maker will be buying. So there is a market making mechanism in which if there is no natural buying, selling. So in general, if we see there are natural buyers, sellers, multiple people, trading on the stock exchanges. But for some ETF, if there is no natural seller, there is only buyers, then it is the market maker or the authorized participant who will provide the liquidity on the other side, be it buying or selling. The mechanism works like this. Suppose the market maker is buying on the exchange. Right. Parallelly, the market maker will sell the units to the AMC and the AMC will extinguish those units by selling the stock. So all this is happening at the back end. The investor necessarily does not need to worry about it. It is something which happens between the AMC and the market maker. Will ensure that the investor gets, as Mr. Vishal mentioned, the real-time price. Suppose the market, for some reason, global or local, comes down by 5%, which is an overreaction, and you want to take advantage of that, you can go ahead and buy at that particular price, which will be maybe 4.5%, 5.5%, lower than the previous day's close, in line with the market.
Okay. So Chintan, if you can just explain, are special product features like SIP and STEP 2P available with ETFs?
Yes. So if you look at the ETF prices, they move in line with whatever is the underlying of the ETF. So the underlying of the ETF could be Nifty 50, Sensex 30. It could be any of the other indices. It could be low vol. It could be BSE 500. It could be many of these other products. It could be any product. And in line with what's happening in that index, the ETF prices should mirror that in that sense to the extent of whatever tracking error that is there. So yes, the prices move in tandem with the underlying index, and that's how the real-time price discovery along with the trading benefits the investors if they want to take advantage of any market movement which is there in the market.
Okay. As sir, you rightly mentioned that if investor want to take the advantage of market movement, so in fact SIP and STP is another way to take advantage of market movement. So could you please tell our viewers, is there any such features are available with ETFs like SIP and STP?
Sure. So I think SIP as a mode of investing in mutual funds has become very popular. I think we are almost touching 13,000 crores of monthly SIP book, which in fact has helped India kind of weather the FI selling as well. You know, FI sold a lot from October 2021 to June 2022, and all of it, or most of it, got absorbed by domestic investors, and SIPs played a very important role. SIP as a mechanism of investing in mutual fund is quite popular. As far as ETFs are concerned, it is traded on the exchange. So the SIP mechanism is slightly different in the sense that there are broking platforms, and your own broking platform would also enable or allow you to have a systematic investment depending on whatever your broking platform allows. And the monthly inflow happens on the exchange itself. So yes, SIP does happen, but it is up to the broking platform that you use and the features that they allow you to participate on a monthly basis, and it is also gaining popularity.
Oh, great. Okay. Vishal, can we invest in all assets classes via ETFs?
So the asset class range is very wide. When we started off, ETFs interestingly didn't start off with equity. They started off with gold as the starting point,
Gold
and they
ETF.
became very popular initially, gold ETFs. And then after that, equity has sort of become the more powerful and more popular asset class as far as ETFs are concerned. So effectively, you can buy either equity, you can buy gold, you can buy bonds or debt, and you can even buy other things which are commodity ETFs. For example, if you want to buy a silver commodity ETF, that's also possible.
Right.
The important part to keep in mind is that for a lot of asset allocation strategies, it's very, very important to also think about international investing. And clearly, ETFs are very, very powerful in being able to give you access to international markets as well.
Right.
So I think as a financial planner or as an investor, you could choose to build an entirely robust portfolio if you would like, just using ETFs in different combinations across different asset classes. ETFs actually gained a lot of popularity on the liquid side because they were used by brokers whenever they wanted to park some cash for investors.
Okay.
Temporarily, because otherwise if it remained there, it earned nothing at all.
Right.
I think over a period of time, the suite has actually increased. So you now have access to products using G-SECs at the underlying level, for example. So like I said, you don't have to restrict yourself to equity only or to gold only if you're looking at ETFs. I think if you don't have the risk tolerance to go to equity, if you feel that you have short-term money, I need the money in a short period of time, etc., then you can very well look at liquid ETFs as well, or you can look at debt sort of ETFs as an alternate solution also.
Chintan, what to look for when researching for a particular ETF? What should I know before investing in a particular ETFs?
First thing, like Vishal mentioned, that asset allocation is important.
Right.
And as part of asset allocation today, most investors would have active funds, and many are looking at passive funds also as a core part of the portfolio. So it is no longer about active versus passive. In India, it is active and passive which coexist. And I think we are increasingly seeing around 75 to 80% of investors' portfolio being in active schemes, 20-25% of the portfolio being in passive schemes. This 20-25% of the portfolio which is in passive schemes, which is index funds and ETFs, like Vishal mentioned a while back, is spread across a lot of opportunities which are now available. Earlier it was gold, now silver is also available. That is the commodity pack. Then there are, SDL, PSU bond funds which are gaining popularity in the index fund category. There are G-SEC ETFs which are available. So debt also as an allocation is there. Liquid ETFs have become extremely popular, and the advantages of they being used as margin for derivatives, or as Vishal mentioned, they being parked for your surplus. So you are trading in markets, or you've invested in markets, you want to book profits, and you want to park your surplus money, and yet have that money available in case you want to invest in the markets again. You can simply park it in the liquid ETF, and then whenever you need, You can invest in the market and sell the liquid ETF, which is generally traded at 1,000 NAV, a fixed NAV, and whatever is the daily accrual. Because the investment in a liquid ETF happens in a fully secure clearing corporation of India, guaranteed tripartite repo agreement, which is called TREPS. It is a very simple instrument, overnight instrument as it is, and it is investing in that. And so you are very secure when you're investing in the liquid ETF, and it gives you the flexibility of basically investing when you need to park your funds, or you can invest when you need to put margin for your derivatives. So I think that is gaining a lot of popularity among investors. Apart from these two, there is nothing much that the investor needs to see. It's just the expense ratio and the tracking error. The liquidity on the exchanges, as I have just explained, there are market makers, and hence you don't need to worry too much about the liquidity on the exchanges. If you like a particular product, if you like a particular sector, and you want to go and exchange and buy it, you should be able to execute it. And these are the main areas. The most important being that if you are investing in equity ETFs, don't treat it necessarily as a trading mechanism, because we just said that you can use real time. These are also meant to be long-term investments. If you want to do short-term trading, they are obviously available, but treat equity ETFs also as your core long-term equity allocation, and the benefit of compounding or the power of compounding will help. There are many products, I'm sure we'll be speaking about a few products also which can suit your basket, but yeah, the overall objectives can be met through these, and you just have to look at expense ratios and tracking errors as two things which you should keep in mind when you're choosing an ETF. Thank you.
Vishal, how much of my income should I put in ETF or say passive fund?
So I think if you had asked me this question a few years ago, my answer would have been quite different. I'll try to give you a today answer for the benefit of everyone who's watching this. So very clearly, if you look at the more recent data that is getting published, there is enough evidence that a lot of active managers are finding it very difficult to consistently outperform their benchmarks. And with products like ETFs, which are available at a lower cost, you're now able to virtually get index returns without taking any of the risk of underperformance because of stock selection.
Right.
So we think that investors today, for their core allocation, especially on the large cap side, need to very, very seriously think about the use of ETFs and index funds, because they're able to get it at a low cost. And we would therefore say that anywhere between 40 to 60% of allocations for most investors can today go to index offerings. This is something that a lot of investors used to say is relevant for international markets, but not relevant for India. Unfortunately or fortunately, the data is also showing that the same difficulty of delivering returns above indices is a problem that a lot of Indian managers also now facing. And therefore, we think that over a period of time, this allocation towards passive strategies will actually keep increasing even more as compared to what might be the case today for between a 40 and 60%. I think all of that is great, but the outcome for the investor is not necessarily showing up very well on an average across active managers. And therefore, I think at least 40% allocation to passives is a good idea for most investors.
So what is the reason for that actives are not showing there for investors? If you could just tell us.
When there was some changes introduced by the regulator around tracking performance in a standard manner against a total return index, you automatically started to see that some level of the outperformance that used to happen earlier reduced because the index got sort of standardized to be a total return index. The second thing that happened is with mutual fund categorization that took place, you started to see automatically that fund managers had lesser flexibility, except in certain categories, in terms of how to allocate. For example, earlier, there was no restriction for a large cap fund manager to allocate meaningfully to mid caps if he felt that the opportunity lay there. With the reclassification that happened in 2018, SEBI mandated that you have to, as a large cap fund, have at least 65% of your money in large caps. Now, what that did is it actually created much tighter frameworks within which fund managers had to operate. And that possibly had some sort of an impact on returns as well. And last but not the least, what has happened over a period of time is as markets become more efficient,
Right.
the discounting of news happens very quickly.
Vishal, could you please tell our viewers about taxation on ETFs? Are different kinds of ETFs taxed differently?
So the ETF is really taxed as per the underlying asset class that is, in that ETF. So for example, if you're looking at equity oriented ETFs, they get taxed just like equity gets taxed.
Right.
So which is short term definition is, up to a year,
Right.
where you get taxed at 15%. If you hold long term, which is something that I would strongly encourage as well, just like Chintan was mentioning, look at a 10% tax rate.
Right.
If you're looking at international ETFs, if you're looking at debt ETFs, looking at liquid ETFs, you're looking at gold, looking at other commodities, they're all taxed in a slightly different manner. The definition of long-term and short-term is different. The long-term definition is 3 years plus, and the short-term definition is below 3 years.
Right.
And the tax rate is below 3 years at your marginal tax rate. So for example, if you are in the 20% tax bracket, you will get taxed at 20% on the capital gain that you make.
Right.
If it's long term, then you get 20%, but the benefit of indexation as well.
Okay.
So in a environment where you are seeing that inflation has been a challenge in India as well, you will find that probably cost inflation indices will start to show an uptrend also going forward. And therefore, after you adjust for inflation, the effective tax rate for these investments may be significantly lower than 20% because of the indexation benefit. So all in all, I would say that tax is very efficient. It's not different for a mutual fund. It's not very different for a stock. It's as efficient. So I don't think investors should be making decisions on whether to buy an ETF or a non-ETF instrument basis tax rates. They are fairly standardized.
Okay. So now, Chintan, I would like to ask you, why are smart beta ETFs are so popular? What are the different factors, strategy indices that AMCs are looking to replicate via ETFs?
Sure. So just to take one step back, till about 5-6 years back, when ETFs were in a nascent stage in India, investors had option of investing in, let's say, large cap ETFs, where the stock selection and stock weightages were on the basis of largest stock with largest weight based on the free float market cap, top 50 names, top 30 names, as the case may be. Then you had mid cap, ETF. Then you have small cap ETFs, which basically have mid cap stocks, small cap stocks as defined, 101 to 250 or 250 to maybe 400, etc.
Right.
Now, if you look at, as the market has progressed, like in the case of US or the West, in terms of how to bring in an element of factors where the selection of a stock is only not determined on the size, but maybe on the valuation, maybe on the price factors like momentum, alpha, volatility. So if you want a set of stocks which are very stable, what is called low vol, why not have a portfolio around stable stocks? So you select 30 stocks out of the top 100 names. So you define a universe, 100, 200, 300 stocks, out of which you will select 30 stocks or 40 stocks or 50 stocks, which have factors determining the selection as well as weightage. So in India, in the last 5 years, the following are the options which have been created and available on the smart beta space. And I'm sure many more will come as the acceptance grows. And we've seen over the last 2 years, smart beta as a concept grow tremendously, both in terms of investor awareness, and we thank you for that, for creating such sessions where investors learn a lot about smart beta, and in terms of AUM as well, where investors have basically allocated. So the awareness and the allocations both have increased. Let's take examples of smart beta quickly. There is one smart beta product called NV20, where 20 stocks out of 50 stocks, in the NV20 index, 20 stocks out of the Nifty 50 are selected, and the selection is on the basis of a score. We moved one step ahead in terms of risk and reward. That is alpha low vol. You combined, it was the first smart multi-factor smart beta index wherein alpha, which is nothing but how a particular stock has performed or how much it has beaten the index. So alpha and low vol, two factors which were combined, basically creating a combination of a portfolio where you had stocks which were winners, at the same time stocks which basically had lower volatility. You combine them in the index of 150 stocks, they can basically participate in that. So it's been quite an interesting journey, and investors have much more options on smart beta now. Thank you.
Thank you. Yes, Vishal, I would like to ask you, if somebody wants to, if someone wants a regular inflow or regular income stream from investing, so in that case, do ETFs give out dividends? And if they, how often?
So the dividends that are given out by stocks, for example, typically go and accumulate within the ETF price itself. So effectively, the collection of dividend is happening from the stocks at the ETF level,
Right.
but the distribution is not taking place yet as far as India is concerned. So they are more products which are designed for growth rather than for steady income as far as India is concerned. Internationally, you can see that there are ETFs which are available which actually pay out a dividend as well. So instead of reinvesting this dividend income, they actually pay it out. I suspect India will also probably follow soon at some point where cash flows will be possible. But today, what may well happen is that some of the broking platforms may allow you to set up a withdrawal system to be able to create an income for yourself. So it normally is better to create income in that stream anyway, because with dividend income, it is not a predictable income. It can go up and down depending on how dividends actually are. And that obviously varies. So your broking platform may be a better solution as far as this process is concerned.
In terms of taxation, I guess, I believe, I think SWP is much more efficient than going for dividend option.
Yes, it normally is much more efficient, especially for those who are in higher tax brackets, to actually use a systematic withdrawal plan process anyway. And therefore, I think, for income flows, you might find that some level of innovation within ETFs in India might be actually desired.
So what is your experience so far, as you are meeting with so many various kinds of investors? So what is your experience so far as the distribution of ETFs are concerned?
So we think the awareness has certainly increased very substantially. The concern that a lot of investors have, which may be unfounded in a lot of cases, is that they don't know whether there'll be enough liquidity at the time of sale. I think especially on the large sort of indices, there is enough of liquidity available. And like Chintan was mentioning earlier, market makers can step in and ensure that liquidity is made available as well. I think what you're seeing is this is going to be a journey. There is going to be an acceptance that's going to happen. There will be early adopters, like in every category. I think the early adopters have already sort of got created. They are out there, maybe talking to investors, talking to their friends, family about how ETFs can give them possibly the best of both worlds of getting access to the price of a stock on the price of the ETF on the exchange live versus a basket of securities at the underlying level. So we certainly think that this is a transition that is already happening. I think smart beta, like Chintan was mentioning, is a very exciting opportunity because it once again tries to quantify the entire selection process and remove some of the biases that all of us may have, either as advisors or as fund managers, when we make certain decisions. For example, as a individual, if I'm very value oriented, but the data shows that momentum does very well in a upward trending market, by knowing that factor and putting it into a client's portfolio, I could overcome my own bias as an advisor in that entire process. Clearly, one of the other things that has helped is there has been more and more movement towards fee-based advice and fee-only advice that has started to happen. And I think that is also something that is helping the entire ETF movement in India. That was a big thrust that happened internationally, and I think it's coming to India as well.
Absolutely, absolutely. So thank you, gentlemen. That was a great insight. And with this, we come to the end of the episode. And I would like to thank you, Mr. Hariya and Mr. Dhawan, for joining us today.
Thank you.
Thank you so much.
Thank you, sir. Thank you. Viewers, we hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You may also share your suggestions and questions at later@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.